Yes, welcome tonight. And I want to share with you something that was an idea that I had earlier this year in 2021, and then um, thought that this would be, would be a time to share with you some of my thoughts. So came out with this title, "Risk is Certain. So what does the data tell us?" Um, so basically, earlier this year. I know that we're coming into winter season now, but around January 2021, remember earlier this year, we're still in the middle of the pandemic, and with uh, all the headline news and the U.S. Changes and whatnot, and then towards the end of the month, reading headline news about something that's happening in the market, um, and there's a lot of changes that's happening. Uh, some of you may or may not have read about the headline news about some activity that was brewing um, in the investment world, the capital markets. And just looking at these terms here, you may or may not have seen these terms. Well, I personally haven't seen these acronyms until I read these headlines, and we all connect to social media and whatnot, and FOMO, fear of missing out. That there's all this emotional um, um, emotions are involved when people are investing or companies are investing and try to be uh, want to be part of a trend and don't want to miss out. And HODL, and uh, when I found out about this acronym, hold on for dear life. So then basically there was some activity by the Wall Street Bets group, comes from the Reddit community there, of gathering all these retail investors to engage into buying a handful of securities against the institutional investors on Wall Street. And I mean, it's quite interesting to see this activity there, and to see that retail investors are having some control of their savings and their investments. But yeah, obviously, this piqued my interest. However, with all this growth and this attitude towards having a quick profit, I am concerned about, um, do people or have their eyes wide open when they're heading into a situation? Uh, you know, there is savings that you hard earned money that you earned, and you want to invest, or getting to situations where you don't may not be aware of the entire situation. So uh, as Sue mentioned, I do teach various courses in risk, and you know um, I just want to share some of my thoughts about the discipline and some techniques uh, to at least get a better sense of what you're getting into. Um, but Yeah, so before we line up what's I'm going to be talking about today, uh, just as Lucy mentioned, I just want to pose this question to you. What does risk mean to you? So, um, when you hear that question, what comes to your mind? Um, Everyone have their own risk tolerances, and just wondering, what does it mean to you personally, based on your experience? So I'll just give you a moment, um, and if you can enter your response in the chat window, that'd be great.
We have several answers coming in. I'm just going to read them out. Uncertainty, taking a chance, potential of losing something when you take a chance, great fear, stepping out of your comfort zone, safety.
Right. Thank you for the response. Yes, you're all right. Everyone from what I hear, everyone have their own situation and how much they can tolerate in terms of risk. And yeah, thank you for sharing. Uh, there is uncertainty. We all don't know for sure what's going to happen in the future, and we all um, have this fear, right, and want to protect what we've earned, at least preserve what we have invested. Um, having a mindset to at least save for the future or save for certain goals. Um, but yes, it's especially nowadays with a lot of information that you may come across, and whether you follow this person on a particular internet YouTube channel or particular um, yeah, interview, you're trying to follow and find out what is the next best thing around, or you have the secret to get ahead. But there is a lot of noise out there, and yeah, thank you for sharing. And you're all right. So for today, the agenda here is remaining time is to ensure that we're all on the same page. I just want to show a short example about looking at risk and at least talk about terminology about risk. Then that would lead into what is some risk management measures that are quite common, value at risk, volatility. And we're going to look at quickly some models that have been used in the financial markets and has been created by a Nobel Prize winner, Robert Engel. To bring our discussion to more of a reality, we're going to use data from various securities, um, securities in the Canadian markets, the US markets, as well as precious metals, base metals, and cryptocurrencies. We all have read about cryptocurrencies and Bitcoin, and you cannot go without of not hearing about Bitcoin and Ether, Ethereum, and all the ETFs, exchange traded funds are out there. So I'll bring this data into our discussion. Okay, to start with a simple example here, just to make sure we're all on the same page. And so let's say today, day zero, we buy a stock A. We buy it for $100, okay? And then we watch the price. The following day, the price rises by $10. So then for that particular day, our return is 10%. The following day, it drops by $5, and then you have a loss of 5%, and then so on and so forth. And then let's say that you hold on to the stock for 10 days until the very end. So you can see here, if you watch the past 10 days, how the stock price has performed, you see that some days were good, some days were bad. But this is what you see in hindsight, right? Now, let's look at another stock B. Here, let's say you bought it for $50, right, on the same day as stock A, and then you have a gain as well on the first day of 2%, no change from day one to day two, and then so on and so forth, right? Now, looking back at the last 10 days here for both stocks, now in your mind, just by looking at these results, these returns, which stock do you um, do you feel is less risky? Which one is more risky? Now, you don't have to answer that question out loud. I'm not going to, you can if you like, but just, in your mind, you might be thinking, okay, which one is more risky? Which one is less risky? But perhaps you're saying to yourself, looks like stock A looks like to be less risky, right? Why? Well, actually, I'd say more risky. Stock A is more risky because there are higher returns and higher losses, right, as you can see here. Whereas stock B, well, there are some days where there's actually nothing happens. So there's less of a positive return or less a negative return. So you may say, okay, stock B will be less risky as opposed to stock A. Now, let's just look at some stats here and see. Now, when we look at the average return of stock A, it is about 0.62%. And standard deviation, think of it as a measure that gives a sense of how far the daily returns have moved above and below the average. So the tendency for the returns to move above the average, then the standard deviation will be higher. If the returns tend to deviate close to the average, then the standard deviation will be lower. Okay. Now, here we have 10 days of returns, right? 10 daily returns. Now, when we look at this, the worst return that you had over these last 10 days was on day 4, where you had a 5% loss. Okay. So we just, you know, looked at some data here and have this quick summary. Now let's look at stock B. Stock B here, well, although we indicate that seems to be less deviation of the returns from the average, it seems, right? It's justified here by the lower standard deviation. We can see here there was one day where the loss in percentage terms, is greater than stock A. You can see here the largest loss for stock B was the most recent day, day 10, which was a 6% loss. Okay, so when we look at here, even though usually the returns don't deviate that much from the average, but there could be a day where there could be significant loss. Okay, so when we look at this, if we look at the largest loss, 5% for stock A and 6% for stock B, how can we interpret this as? We do have a very, very small sample set of data here, but you can interpret this, loosely speaking, in this manner, that for stock A, based on the data that we have gathered, we have 90% confidence that the maximum loss over one day is 5%. Now for stock B, we have 90% confidence that the maximum loss over one day is 6% based on what the data is telling us. Now, I understand we cannot always look backwards to move forwards, but it's good to get a sense of the investment that you're getting into or the asset that you're investing into. So based on what the data is telling us here, this is what it shows us. Now, if you have any questions, please do enter into the chat and we can address them. Otherwise, we can address them at the end as well. So this is one way to interpret this loss. The other way to interpret this is this way. There's a 10% probability that the loss for stock A for any given day, right, will be greater than 5%, given what the data is telling us. For stock B here, there's a 10% probability that the loss will be greater than 6%, given this small sample size of data that we have here. All right. So it gives us a sense of, someone mentioning before, what is risk to you? A chance, right? A chance of earning a profit, a chance of losing. But this gives you a sense of the magnitude of the loss, given a time horizon over a day, and the probability that that will happen. Now, if you invest $100 or $50, the maximum you could lose is 100%. So although it gives us a sense that there's a 10% probability that the loss is greater than 5%, but we don't know how large that loss will be beyond the 5%, as well as how large the loss will be beyond the 6%. But at least it gives a sense of what we're getting into, okay? And what you're prepared that could happen. Okay, so, for the past 18 months or so, I'm sure that Metro, we've been visiting Metro more than normal. So I've compiled, downloaded some data about the Metro stock. So for the 100 trading days from June the 8th to October 29th, so just last Friday. So what I've done here was just download the daily prices for the Metro stock, and then just show you what we have here is a histogram. So histogram basically visually shows you the distribution of the daily returns from June 8th to October 29th. So here, this is where you have losses, and this is here you have gains. So the best return was 2.2% over this 100 trading days, and the worst return, the largest loss, was 2.116%. Because we're dealing with 100 daily returns here, if the largest loss that you observe was 2.116%, then based on our example that we showed you previously, that we have 99% confidence that the maximum loss over 1 day will be 2.116%, right? Given we have 100 trading days, so we're using our largest loss as a measure and giving us a certain level of confidence, 99% level of confidence that the maximum loss for 1 day is 2.16%. On the flip side, you can also say that there's a 1% probability that the loss over 1 day is greater than 2.16%. Okay. Now, 100 trading days is not that much in terms of data. So um, we can add data, and I'm going to come to that in the next slide. Now, instead of, let's say we can change the confidence level. If we pick the 10th worst return over this 100 trading day horizon, well, there was a 0.994% loss or close to 1% loss, which was our 10th worst return over this 100 trading days. Okay, so you can say with about 90% confidence that the maximum loss over 1 day will be 0.994% or close to 1%. On the flip side, there's about 10% probability that the loss is greater than 0.994%. So you can see here that we can define um, different confidence levels of in terms of the maximum loss over a certain time period. Now, the data that I've collected here, they're basically daily data, but you can collect weekly data, monthly data. So the definition of your time horizon in terms of level of losses at a certain confidence level can be defined based on the data that you collect. Okay, so instead of 100 trading days, looking back for the last 20 years for Metro, right, the stock here, and looking at over this 20-year period that um, if we look at the 53rd worst return, because there are almost 5,300 trading days, at that loss level was 3.581%, or roughly the top 1% in terms of losses. So we can say we have 99% confidence that the maximum loss over 1 day is 3.581%, or 1% probability of the loss will be greater than 3.581%. Okay, so obviously you can select the data, whether it's over a 20-year period or the last year, the last 2 years, that will have an impact to your loss level. But just to show you, uh, you can still interpret the same information no matter how much data that you have, like similar information. And again, 90% confidence level um, over the maximum loss over 1 day is 1.326%. So at least you can get a sense of, as I said, what you get yourself into. What, how bad can things get? Okay, Toronto Stock Exchange, right? The 99% confidence level was 3.124%. So there are very few occasions when the losses have actually exceeded 3.124%. But at least um, you have a mindset now. Obviously, when you're investing, you want to, depending upon risk tolerance, You want to earn a certain target return, but you need to have a sense of how bad can things get. Okay. So just summarizing for the last 20 years, so if we look at Metro and the Toronto Stock Exchange and other ETFs over this 5,000 trading days, now just summarize to the 99% 1-day VAR. So what I have just explained to you is called value at risk. So you have a 99% confidence that the maximum loss over a 1-day period is 3.581% for Metro, 3% for if you invest for the broad market for Toronto Stock Exchange, um, and so on. So VAR, that stands for value at risk. Okay. So it's a very, very popular measure in risk management. The issue with this risk measure is that we don't know how bad the loss can get once you surpass this level of loss. But at least you have some quantification of the uh, of the loss levels. Now, if you invest into this is a product by BlackRock iShares. This is a universe of bonds, about 1,400 bonds in this exchange traded fund. Um, So exchange traded fund is a way that you can invest to have exposure to many securities, so you can benefit from diversification. Now, in this exchange traded fund, we have investment grade bonds, um, well, issued by different levels of the government as well as investment grade corporations. You can see here the 1-day VAR is quite low, 0.93%. Um, as opposed, if we invest into the 60 largest Canadian companies that are traded on the Toronto Stock Exchange, looking at 3 times that in terms of your 1-day VAR. Okay, and if you look at common stocks that many Canadians hold in their portfolios, Royal Bank and Bell, you're looking at a higher 1-day VAR compared to the overall Toronto Stock Exchange. But at least in your mind, you have some, at least you can rank now, right? You can rank if you're going to have any of your investment at risk. Now you have another idea when you're going into investing. Okay. A BlackBerry, I'm going to be talking about meme stocks, but BlackBerry here has has been a has got a lot of attention from the Wall Street Bets community, and since then, the 1-day VAR on this stock is significantly higher. I'll show you, pre-pandemic and after pandemic, how the VAR measure for BlackBerry has changed significantly. Now, you may be thinking, well, 99%, 1-day VAR, perhaps that is too high of a confidence level, right, in terms of defining maximum loss. So 90%, or you can think of it, there's a 10% chance that the loss will be greater than these loss levels based on what the data is telling you. Okay. So this is 20 years of data. Now let's look at the US. Because I wanted to have um, all of these, the blue chip stocks, um, popular stocks, consumer stocks, and these meme stocks. So highlighted in red here are these meme stocks that have been traded by this Wall Street Bets community. So I picked a timeline here from December 2013 to just last Friday. And again, just looking at the data and looking at the 1-day VAR at a 90% confidence level and a 90% confidence level. So you can see here, I guess it doesn't surprise you that the VAR for these meme stocks are quite high, right? Much higher than these more traditional blue chip stocks that we have here. Um, but yeah, so now hopefully, um, whether you're already aware of this measure or not, hopefully more people know about this, in my opinion, uh, before they invest into an investment. Um, and then for savings. So you can see here with Bed Bath and Beyond, a retail chain in North America and beyond, that over a 1 day period, there's 99% chance, well, there's 99% confidence that the maximum loss you have is 12%. So that's quite high, right? Or there's a 1% chance that the loss will be greater than 12%. So um, this is what the data is telling us in terms of the value at risk. Okay. And just want to let you know that uh, these a summary of these slides can be made available to you. So I do have a lot of graphs later on in this slide deck, but so I just want to let you know you can just sit back and just listen. Okay, thanks. So how about precious metals, gold and silver? When we talk about gold and silver, we cannot forget about cryptocurrencies such as Bitcoin and Ether on the Ethereum blockchain. You can see here that the cryptocurrencies has much higher levels of value at risk, right? So you're looking at more than Bitcoin, more 5 times higher level of VAR, and Ether 7 times higher level of VAR compared to gold. Um, so the numbers don't lie here. This is what is the value at risk is telling us. And I just picked 99% confidence level and 90% confidence level as just a round number that we can remember. But you can always pick a certain confidence level yourself. You can pick 85% or 95%. Um, it's just giving you a sense that with certain confidence level, what's the maximum loss that you will expect over a 1 day horizon. Okay. So that was a quick discussion on value at risk. So um, hopefully that is something new for you, and that you can think about when you're making these decisions. Um, so next we're going to talk about volatility. And um, volatility, you can think of it as the higher the volatility, the more uncertainty there is in your investment, in the outcome. We're going to look at various ways of quantifying volatility. A standard approach, EWMA, stands for exponentially weighted moving average, and the Garch model, which I'll show you shortly. Now, because we have a short time tonight, towards the end, I'll leave you with some information about, you can go on yourself and generate your own um, reports regarding volatility of various type of securities that are out there. All right, so now let's talk about volatility. Going back to our example of stock A and stock B, remember here we're talking about VAR, the largest loss, given a certain confidence level. Now, the next couple of slides, I'm going to be sharing some formulas with you. So, for those um, that it's been a while that you have seen formulas and whatnot, uh, just to wrap our head around when I'm explaining measure these models, volatility models, that at least save some space on the screen. So the stock price here, right, is basically labeled as S, S sub I, meaning S sub I meaning the day, the return, the average return. So averaging all of these returns is U bar, or each of these daily returns is U sub I. And then we have something called the variance and standard deviation, sigma squared and sigma n. So I've relied here on Excel, or you can rely on any other tool to calculate some um, some measure of uncertainty of the returns. So uh, we can say that the higher the standard deviation, the tendency for returns to be above and below the average tend to be high, much more higher than the average and much more lower than the average, the higher the standard deviation. The lower the standard deviation, then the returns don't deviate that much from the average. So you can just think of it that way, okay, at this point. Now, calculating the standard deviation variance here, I just use all of this data, okay, all of these 10 daily returns. Now, the issue with this is that whether the return that was realized just happened just yesterday or 10 days ago, these returns have equal weight or equal impact in terms of measuring the uncertainty. But this could be problematic. What happens if we have 1,000 or 2,000, data points? What happened 5 years ago may not be as relevant as what happened this past week. So there is a flaw with this method in terms of getting a sense of the uncertainty or volatility that we're currently facing. Okay, so right now we're at Tuesday night, and let's say that we have collected data about about um, of our assets and our securities, and the market's closed, so we have the most recent price. Now, based on what happened today, we can use this information to update our model. Okay, so what we just calculated in the previous example was calculating the variance by looking at how many um, days of data that we have, the daily returns, and the average return. And as I mentioned before, the if returns are much higher or much lower than the average, then your variance or your volatility will be higher. If the daily returns are they're quite close to the average, then the variance or the standard deviation will be lower. Okay, but you can see here that we're equally weighting old data and newer data, and we can use this model to forecast what could happen tomorrow. Now, to simplify things, because when we have uh, quite a significant large data set, we can assume that the average return, just for risk management purposes, is close to zero. So to simplify things, we can say, hey, the average of all of the squared returns gives us a forecast of volatility or variance. This is step one. Okay. And but the problem still that we have here is that whether the return happened 2 years ago, 5 years ago, or just last month, you'll have the same weighting on your model for forecasting volatility. Now, M here represents the number of trading days. So we have 10 trading days, then M is 10. We have 100 trading days, then M is 100. So basically, you're applying equal weight to your data points or your returns. Okay, so how can we improve upon this uh, to use our historical data more effectively? Well, instead of applying equal weights for all of our historical data, why don't we apply different weights? Perhaps what happened to our securities the past week or 2 weeks, we apply a higher weight. And then whatever happened a year, 2, 3 years ago, we apply a lower weight. So at least you have some discretion of applying weights, um, so indicating what impact those returns will have to your models to quantify uncertainty. Okay, so taking it one step further, we have this ARCH model. This is an auto-regressive conditional heteroscedasticity model. This model, well, Robert Engel won the Nobel Prize in economics for his work with this model. Um, and the difference between the previous model here and this model is that this model also incorporates some long run variance. So you may look at there could be some reversion to some average long run variance rate. So there's some stability with this model here. Okay, or you may have some um, foresight of what the long term variance will be, but there is some um, stability with this model. Okay. Now, um, if you want to learn more about this, we have from Professor John Hall from the University of Toronto. He has various readings on this and some examples as well in this regard. Now, a model that I'm going to use in the next graphs is called the exponentially weighted moving average model. Now, this model of quantifying volatility, uncertainty, the returns that just happened, let's say Tuesday, we update the model. And then um, the forecast that we had yesterday and the day before, um, you know, is now have a lower weighting. So this elegant model here is that as each trading day goes by, you're updating your model with the most recent return. So as that return, that data point becomes older, there's less weighting or less impact it will have on forecasting your volatility. Okay, so there is no mean reversion, like no reversion to a long run variance rate here, but it's still effective. Okay, so this is the model I'm going to use when I show you the graphs and looking at these various securities. Now, this model here, which is part of this website that I'll show you towards the end, the generalized autoregressive conditional heteroscedasticity model. Now, this model here actually combines the ARCH and the EDIA model. So this model here, in order to forecast uncertainty, volatility, we use the long run variance rate, whether you use historical data for that or you have some forecast of that, of your security or asset. The return that just happened today, you update your model, and your previous forecast that you had. So we have three inputs to the model here. Okay. But as I mentioned, this is the one I'm going to show you in the remaining slides. Okay, so instead of using the previous model, now I'm going to use this model here to get a sense of the uncertainty with our underlying investment. Okay. So having said that, now let's look at some data here. So we're going to have various sections here. I'm going to look at the Canadian, the stocks, the investments are traded on the Toronto Stock Exchange. Then we'll look at United States as a group, including the meme stocks and some other popular stocks, and then looking at precious metals and cryptocurrencies as one group. Okay, so what we're going to do here is that I'm going to only focus on the last 2 calendar years, 2020 to 2021. Okay, and I have used the EWA model here. So updating my model with daily returns. And I've also plotted out the 1-day VAR at the 90% confidence level and the 99% confidence level. Okay, so let's look at the Canadian securities here first. Okay, so going back to Metro, so this is from January 1st, 2020 to last Friday. So the green line here represents the 1-day VAR at 99% confidence. The red line here represents 1-day VAR at 90% confidence level, and the daily volatility. Okay, so you can see here that leading to the pandemic, the 1-day VAR significantly increased. Well, many securities have higher VARs once the pandemic came about. Now, the bottom part of this chart of this slide here is showing you the stock price of Metro. So when the volatility or the VAR rises, you can see here there's an impact, tends to be an impact to the stock price, right? More or less on a negative basis. So this model here that I have, I update it on a daily basis. You can see that the VAR changes as we have newer data, right? More data that we capture, we update the model. Then the older data will have less weight. Okay, so now now we're at a VAR at about 2%. Okay, so there's 99% chance that 99% confidence level that the maximum loss over the 1 day horizon is 2% loss, or 1% chance that the loss will be greater than 2%. Okay, so that is Metro, right? How about the overall Toronto Stock Exchange? Well, the 1 day VAR rose to 12%. Even at 90% level, it's like about 7%. You can see here uh, the VAR increased, well, and the Toronto Stock Exchange index level fell. Now, as uh, from the uh, the peak of the pandemic, you can see here that the index level has gradually increased over time, and that coincides with the volatility falling. So typically when volatility rises, that coincides with a downturn in the prices or the levels in the markets. And for you and I to invest into the Toronto Stock Exchange, we have the 60 largest market cap companies. Here, the VAR is similar, right? Whether you invest into the 223 constituents here or the 60 largest companies. If you're more conservative, investing into the bond ETF, you can see here that the VAR increased to 6% level of loss. Um, and that also coincides with the downturn in the ETF price from about $33.50 down to about 29. Okay. You can see here, whenever VAR increases, volatility increases, that kind of coincides with downturn in the level of prices or in the index level. Now, it's more interesting to combine these securities together. So over the same period from January 2022 last week, I've overlaid in this graph the bond ETF, the equity ETF that invests to 60 largest market cap companies on the Toronto Stock Exchange, Royal Bank, Bell, Metro, and BlackBerry. You can see here, pre-pandemic, the volatility VAR for these 6 investable securities are more or less within the same range. Once the pandemic happened, the VAR increased much, much higher for BlackBerry as opposed to bonds. So bonds, the VAR did increase, but it increased as much as BlackBerry. Second highest VAR is Royal Bank, followed by Bell, then followed by Metro, okay, and then followed by the bond ETF. But since then, since the height of the pandemic, you can see BlackBerry, it has disconnected itself. It seems like, right, in terms of the VAR. Now since then, BlackBerry volatility has increased dramatically compared to the other investable securities in Canada. Now, the Wall Street bets, um, that activity happened at the end of January. So it coincided with this, and during this month here, with all the activity with the Wall Street bets movement, increased BlackBerry's VAR much higher. Now, disclosure here, I did have a position in BlackBerry, but once I saw this, I basically sold. It was getting um, too risky for me at this point. Um, but again, the meme stocks came back to popularity around the mid June, and that coincided with higher levels of VAR. Okay, but you can see all the other investable securities in Canada, their VAR are more or less in the same range. Now let's move to the U.S. Securities here. Okay, so the S&P 500 uh, have similar VAR compared to the Toronto Stock Exchange. So during the pandemic, the VAR increased 12% loss for a 99% 1 day VAR. NASDAQ, primarily with technology companies, right? You can see here the VAR, the volatility increases whenever there's a downturn in the index level. You see when there's a downturn here, the volatility increases. based on the EWA model. When there's a downturn here in the NASDAQ, that coincides with the increase in volatility. Okay, so again, hopefully having this additional idea gives you hopefully a more well-rounded picture when you're investing your savings. Here, right, the more well-known type of companies: Johnson & Johnson, Procter & Gamble, and Kimberly-Clark. Johnson & Johnson Pharmaceuticals, medical devices, healthcare, Procter & Gamble as well. Consumer products, healthcare, Kimberly-Clark, also in medical devices. So you can put these, I like to put these companies in the same group because uh, they are well known and have quite a lot of history and have similar presence in the market. You can see here their VAR is quite, they overlap with each other during this time frame. Now, Kimberly-Clark here, right? They basically, if you know about Kleenex, they're the ones that produce Kleenex. Um, their VAR, peaked at certain times more so than the other two companies, and that coincides with the downturn in the stock price. So what could have happened here? It could be some headline news. It could be some news release. So there are many factors that could have caused the volatility increase. Now, there's a lot of research that can be done here, but at least it gives you a sense of which uh, points in time have been critical, right, with this investment. Now, look at technology companies: IBM, Apple, and Microsoft. Um, if you look at their VAR, was at 8%, right, as a peer group, versus Johnson & Johnson, Procter & Gamble, Kimberly Clark was about 6%. So as a peer group, their VAR here was much higher during the height of the pandemic. And more recently, the VAR is about at 2% level. Okay. Um, Whereas this peer group, it closer to 1%. Okay. Now something's happening here with IBM. Their VAR significantly increased by about 33% over the last couple of weeks. And it coincides with a downturn in the IBM price here. Okay. Next, Home Depot and Walmart. So as a small peer group here, you can see with Home Depot, the volatility for this particular investment was much, much higher, about 33% higher than Walmart. And if you look at how Home Depot performed, right, lost about $100 within a couple of months. Um, so, it gives you a sense about what you have at risk during that time. Okay. Meme stocks. So, um, okay, we're at 8:01. Hopefully, I still have about 5 more minutes. Um, but if not, just please let me know. Um, so here we have meme stocks. There are five meme stocks here: um, BlackBerry, um, Bed Bath and Beyond, Nokia, GameStop, and AMC. Now, to make it more clear here, I'm just going to split this group into two. GameStop and AMC had much higher volatility than the other three meme stocks. Now here, AMC, at the peak of the Wall Street bet movement, the VAR here at 90% level, you could lose all of it, 100% loss. Okay, there's a 90% confidence that the maximum loss will be 100%, right? As opposed to the GameStop stock. So it's quite interesting, but you can see even during recent times, the VAR level is still quite high compared to the other stocks we just looked at, right? With the other peer groups. The other three meme stocks here, their VAR levels did increase at the same time as GameStop as well as AMC, but the VAR wasn't as high as the others. Okay. But so as you can see here, it comes in waves based on the Wall Street bet movement. But you have to be careful during these times. But now because of VAR, you do have a sense of how much you can lose with a certain probability over a 1-day horizon. Okay. And moving to the last peer group here, looking at metals and to cryptocurrency. So at the top half here, we have gold, silver, and copper. Here I plotted the 1-day VAR at a 90% confidence level. At the bottom here, we have the 1-day VAR for Bitcoin and Ether. As you can see here, with no surprise, Ether on the Ethereum blockchain has the highest level of VAR compared to the other investable assets. Okay, so there's a 10% chance that you can lose more than 16% during the height of the pandemic, and and more recently in terms of the Wall Street bet movement, and then followed by Bitcoin, then followed by silver, then followed by gold and copper. Now, gold and copper can uh, change their positions in terms of which one will have higher VAR levels or not. Now, when we talk about gold, it's more or less as a precious metal. With silver, it's more or less an industrial and a precious metal. And there is some activity with the futures market that have impact to these prices. Now, these prices here are not buying the bullion where there's premium. These are just trading over the futures market as well over uh, the the stock market. Okay. So here, when you do watch some headlines or read the news, when they say gold is too risky, but then now you have a sense of the ranking. What is the data telling you here in terms of VAR? All right. So hopefully it gives you a little bit of peace of mind of what you're getting into, right? Um, so having this data gives you at least, you know, we cannot guarantee what's going to happen in the future, but having a sense of what has happened and how it performed relative to other securities give you a better sense to make a better decision. Okay. So gold here, 6% VAR at the peak of the pandemic. Silver, higher VAR compared to gold, right? Throughout the same time period. Copper, well, with the green movement and the electrification movement, you can see copper's VAR has increased. Now, if you look at the other securities, when volatility increased, that coincides with the prices falling. With copper, it's actually the opposite. You can see that there is some movement in the prices trending upwards, and that also coincides with higher volatility. So this is quite interesting here. Okay, so there seems to be, um, you know, some quite a lot of interest in the copper market. And yes, here with Bitcoin. So we can see that there's a pattern here, what I'm showing you. Okay, these are just VAR measures over time. And the model just takes most recent data and just updates it. Older data has less impact to the volatility. Okay, so I know those are a lot of slides, but as mentioned before, uh, I will distribute a version of these slides, and hopefully, uh, as I said, gives you additional insight as you are putting your hard earnings at risk. Now, some resources to leave with you. Um, so Robert Engel, as I mentioned, the Nobel Prize winner in economics, he created this Volatility Lab out of the Stern School of Business. And this educational material from Professor Hall, where he has some examples and models of calculating volatility. All the data I've shared with you here, it's all for free. You can download it from Finance Yahoo, And I suggest that you use the closed price, not the adjusted price, when you are, if you want to, um, download some data. Okay, so just quickly, I'll show you this website here, the Volatility Lab. Okay, just bear with me when I go to that website. Okay, so this is the Volatility Lab website. Now, this website here, basically, you can calculate the volatility of any publicly traded security. You can, click on a particular country and look at telecommunications. If I click onto there, here they have already plotted the volatility. Now this is an annualized volatility. If I click on Bell, okay, and I can also choose a particular um, time horizon in terms of plotting. I can type into here, I want Home Depot, and then this is the volatility, okay, of Home Depot. And you can start to pick different time periods. So here is the volatility. Now this is not VAR, okay? To calculate the VAR measure, I made some simplifications in terms of the assumptions, where I assumed a normal distribution for the daily returns. Now, to be more precise, there are ways to uh, have more accuracy, but for purposes of this talk here, I just want to give you the idea of the value at risk measure using these models. So, and the bottom here shows you the daily returns as well as the price. All right. So, yeah, this website is quite useful, where you can go and zoom down in any country and look at their securities, and you click at the volatility by industry. All right. So they used here the Garch model, and you can pick various versions of the Garch model in order to calculate your volatility. Okay, so um, yeah, thank you for your time. And I know I share a lot of information.